On the intro slide today, I gave this caution sign, watch for falling rock. The reason I put that on is it reminded me of the first video I'm going to play for you, where Tom Lee from Fundstrat talks about inflation falling like a rock. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is July 2nd, 2024. This first piece I want to play for you is from Tom Lee, and I know, in my opinion, I think he's credible. There are some people who have commented that they don't care for him, but he predicted a few months ago, I don't remember exactly, it might have been May or June, and he said at that time the S&P 500 was, I don't remember where it was on that day, but it seemed like his prediction was it was going to 5,500 by June. Okay, well, by June 30th, it was just about 5,500. So amazingly, I didn't think he would hit that. And now he is making a prediction to the end of the year. But he's also talking about, in this particular one, he's talking about inflation coming down, and I'm going to play a couple of pieces on this. Inflation falling like a rock, dropping down from where it is now down to the 2% range or 2.5% range. So quite a bit. And so anyway, I thought it was, you know, I have not followed his track record to say how precise he is or how accurate he is, but he's been different in a better way than a number of people on Wall Street. But anyway, take a listen to Tom Lee.
That 5,500 number, but it doesn't necessarily reflect how you think the year is going to end. Are you going to take a look at your year-end targets now?
We are, Carl. At the early December last year, we thought S&P could reach 5,200 this year, which at the time was almost a 20% gain. We've obviously moved well above it, and the fundamental picture to me looks stronger. I think earnings next year, we originally thought would be 260 for 2025. It's probably closer to 275. I think the war on inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock. These are factors that give us comfort that multiples can expand. And so I think 5,200 is clearly too low, but I don't know how much above 5,500 there is into year end. So I think in a couple weeks we'll be addressing that.
Now I'm going to play a piece from Tom Lee again. Two separate interviews, separate days. I thought he wore a little bit better shirt this time. He's making a bold prediction. People who make predictions, my hat's off if they're accurate. And he is predicting from now to the end of this decade, so that's about 5.5 years. He is predicting that the S&P will triple, that it will go from 5,500, let's say, to 15,000. So that would mean a compound rate of return of growth rate of between 15 and 20%. I don't know the exact number, but quite a bit. And he cites examples in the past 100 years where that has happened, where the structure of the economy and the demographics are such that that literally has happened twice. And he says in the last 100 years, this will be the third time, and he gives his reasons for it. The drivers behind this are that there is $3 trillion worth of labor shortage, where people are looking for workers and they're not there. 3 trillion. Secondly, so demand driven. Secondly, the expansion of AI, which ties into probably the labor shortage to take up a good portion of that shortfall. And thirdly, as a result of that, money coming into the U.S. This is, again, think in terms of 5 to 5.5 years. he will explain the detail on this. I thought it was quite interesting. I'm not saying I completely agree with him, but I'll cover that. Then he talks about, then Brian Sullivan asks him the question, what are the risks behind that? And he gives three of them, potentially, issues that could come up. One, a global recession. Two, AI could be used in a negative way against nations in an adversarial way. Hadn't thought of that. And it forms a bubble by doing this, an even bigger bubble than we have today, and that the peak of that bubble occurs sooner than 5.5 years. So I thought those were all fair assessments of the risk. I think I want to make a comment on this. I believe, because it's been 15 years since we've had a serious pullback or a crash, and I'll call that 2008, 2009. 2000, COVID went down for a month and then went straight back up. I don't count that. 2022, it meandered down. The S&P at its worst point lost about 24%, ended down about 18%. That's not what I would call a crash, not a major crash. So I think we are overdue for a crash. So when is that going to happen? I don't obviously know. I would say, I think in terms of the next 2 or 3 years. So during this time frame that he's talking about, I think we are, for some reason that maybe we don't even see today, that there is a crash coming. Maybe it'll go for 5.5 years. I don't know that either. But whenever that happens, what has happened in the past is there is a crash. The market goes down, let's say 30 to 50%. That's the kind of crash I'm talking about. And then it rebounds off of that. And now it may take years to get back to where it started, but from the bottom, it generally, at that point, it takes off. When you look back, there's numerous examples. 2008 was certainly one of them. 2003 was one of them. The late 70s, early 70s, and even if you go back to the Great Depression. In the Great Depression, the stock market dropped from 1929 to 1932 and then rallied 3 times. 32, 35, and 37, it went up an average of about 90% per year. We don't think of that. And yeah, we were in the heart of the Depression, but the stock market took off. Why? Because the air had come out of the balloon. Things were terrible from the standpoint of the economy and the stock market, but once enough air comes out of the balloon, then things tend to accelerate. And so maybe what he's saying is correct. Maybe it will triple by the end of the decade. But in my opinion, I think it will at a minimum be a very rocky ride. And maybe in that period of time, there will be the collapse that I'm talking about. But anyway, he unpacks this and gives some good rationale. So take a listen again to Tom Lee.
Let's ask the man himself, because he's sitting right next to me. Tom Lee, good to see you.
Great to see you, Brian.
You have not been drinking.
No.
Okay.
Not
yet.
recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay. Well, there's a couple of reasons behind this. One is this would be the 3rd time that stocks entered a cycle where annual returns compound at high teens. You know, you had the roaring 20s, and then you had the 50s through the late 60s. Mm-hmm. And this is a 3rd cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
Mm. So is this the law? Okay, so math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years?
Yeah, so it's a
Demographics.
exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have really a big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
Do you have a view? Is this because we're the United States? I mean, and do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems. Will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. That's roughly $3 trillion of labor shortage, of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to have a $3 trillion revenue run rate. On top of that, if U.S. companies are growing earnings at this speed, the PE multiple of the U.S. should go up, and that's exactly your point. There's going to be capital flows into the U.S. And where else in the world do you find the best and most important technology companies? They're all basically in America.
They're all here. I mean, it's amazing to me that NVIDIA alone, folks, NVIDIA by itself is worth 50% more than the entire German DAX index of stocks combined.
Yes.
The 30 biggest companies in Germany, or 33, however many are in the DAX, combined are half the size of NVIDIA.
Yeah.
Because we have liquid capital markets. We have American ingenuity. We have an amazing workforce. 25% of company founders, by the way, are not born here because we allow a lot of immigration. It's a bold call. What's the risk? When you look at it, you've always got to analyze, say, well, where could I be wrong, right?
Yep. Well, I think there's a risk that we could have
Global recession?
A global recession. AI, of course, could become an adversarial development and, upend state nations and cause chaos. But we could also have a risk that it's a bubble and it peaks a lot sooner.
Next, I want to play a very brief piece from Professor Jeremy Siegel from the Wharton School. And he has been bullish on the market, and he's, at a time, you go all the way back to 2022. In the fall of 2022 was when I first played a piece from him in, I think, September, October. And he was bullish on the market at that time, and correctly so. So there were people who were on the video who were critical of maybe him or me for making that statement, but he does tend to be bullish in his comments. But he says that he believes there will be a rate cut by September, and that's not inconsistent with what Tom Lee said. So maybe that will happen. So most people are saying there's going to be at least one this year, and maybe it's as late as December, but September, December, something like that. So take a listen to Professor Siegel.
On the economy, I would say the recent data has been on the weakish side, not real weak, not a recession scare, but we were coming in 3%. A lot of people, the second quarter, 3.5%. I would say we're barely two at this point with the data coming in. And given the good PCE data and what I think is going to be very good data for inflation in the second half, I really think the Fed should tee up a cut on the July 31st meeting, confirm it at Jackson Hole in August, and do it in September.
And finally, I want to play something that does not relate to the economy. Well, it does relate to the economy a little bit, but not economic data, and does not relate to the stock market. But it's related to debt. And so I saw this on CNBC. I thought I'd play it for you because it was interesting to me. And the theory or the information behind this is that people are going on vacation and paying for it with credit cards. So people are in debt. The amount of credit card debt is 1.15 trillion, and it is going up. Let's see, in the last year, I believe it went up 129 billion, if I remember correctly. Why would people use credit cards? Well, you use credit cards because it's your best or easiest source of credit. And why would you use that? Because your income is not enough to meet your expenses. So if people are faced with, okay, I've got to buy food, I've got to pay my rent, I've got to pay utilities, transportation, gas, etc. You say, I've only got so much money. I'm maybe working an extra job, and then it's like, what do I do? And so people, I think most people use this as a source to fill in the gaps where they don't have enough money. That's happening because of inflation. So, but vacations are optional. They're not a requirement. They're not like food and rent and, gasoline and so forth. So it's an interesting statement about Americans, about us as Americans, that we would actually think in terms of doing something as discretionary as a vacation and paying for it with debt. In other words, not paying for it. I'll pay later. I personally just don't look at it like that. So if I don't have the money, I'm not going to do it. But apparently there are a lot of people who are, and this is what this video talks about, is paying for vacations with credit cards. So take a listen.
The average vacation cost for one person in the United States is a little under $2,000 per week.
More than a third of summer vacationers, 36%, are willing to take on debt this summer for their travels. The reason that's worrisome is because the average credit card charges over 20%, which is close to a record high. I don't want to tell people they can't have any fun, but this represents a lot of people taking on expensive debt. And this is the kind of thing that can linger.
Globally, 72% of millennials and 65% of Gen Zs said they plan on spending more on leisure travel in 2024 compared to 2023. In the US, 47% of millennials and 42% of Gen Zs said they plan to take on debt to go on summer vacation.
There are so many compelling reasons why people choose to take on debt to have these vacations. If your kids are dreaming of going to Disney World and there's no way the family could ever really swing it without going into debt, it could be a memory the family will have forever. Parents often can rationalize spending in these terms for their children.
Here's how Americans are paying for their summer vacations. Credit cards are the most common way people pay for their vacations. 62% of Americans surveyed said they put at least some of their trip on a credit card. Financial experts say that this can be a risky move if the borrower cannot pay the balance in time to not be charged interest.
The average credit card balance is already over $6,000, according to TransUnion. If you add $1,000 in vacation expenses to that, maybe it feels like a drop in the bucket, but it just makes it that much harder. That $6,200, if you make minimum payments at the average interest rate of 20.7%, you're going to be in debt for 18 years, and you're going to pay more than $9,000 in interest. So some of this is making a bad situation worse.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.